Well, I'm here today with Marc Cooper. Marc is the CEO of Solomon Partners, and he's held that role since 2016. Before that, he was previously the vice chairman. Lots going on in the world of finance at Solomon Partners, Wall Street, mid-market, and Marc, you sit at a spot that's center of all of those activities. How's the world of medium, small, and not so small businesses doing?
Uh, First, Jim, it's a pleasure to be on your show. I know we go back a long way. Our firms go back a long way, and it's really gratifying to participate with you. It's an interesting market. We're still dealing, interestingly, with the fallout of COVID, with the zero interest rates, with the uh, incredibly robust activity that followed the COVID swoon. And it was a little bit of a feeding frenzy, and people are still living through that. The good news is 22, 23 were pretty darn difficult in the M&A market. 24 started seeing some positive cracks, particularly with the strategic buyers who are sort of less time sensitive and more strategic in their view of acquisitions, as opposed to private equity, which is it has to fit within a certain framework. So you saw more activity there. Then you saw more activity in the larger cap, the billion plus M&A activity, and I can go in for another 10 minutes on why, but really a function of the more stable, large cap private equity buyers who weren't necessarily smitten the same way as the mid-market and up and coming private equity players who were able to get back into the marketplace. And now you're seeing the green shoots of the middle market, of the sub-billion-dollar transactions, and that's where all the pent-up demand sits, with a whole host of portfolio companies that are getting fairly long in the tooth. 5 years is typically the horizon. We're down to seven,
In the private equity portfolios, right?
and they're starting to trade. First, you sell your best, the A assets, and they've gone pretty darn well and pretty good multiples. The real test will be price discovery. Does the seller accept the new norm in valuations and move these portfolio companies out, return capital to shareholders, and get back to business as usual? And we feel pretty confident, and I've felt confident this way for 3 years, so mind you. But I think 2026 is going to be the year, and it's not going to be the dam breaks and all of a sudden, no one can breathe and it's hair on fire. It's going to be a steady stream of activity.
Marc, you've been around this business a good while now, and different sides of the business. Uh, some people are saying that with this backlog in the private equity space, a lot of funds who have had success struggling to raise new funds, especially if they have a backup in their portfolio load. Has private equity changed as a result of all of this?
So it's narrowed. So this was the long dissertation I was going to give you why the mid market has not fared as well and has been a little bit more subdued. So what happened through the late 2000s, or the late 2000s, 2010-ish period, as we got out of the Great Recession, interest rates started coming down, mid-market portfolios, mid-market sponsors started to grow. And they started off at $500 million funds, then billion and a half, and then 2.5 billion. And then with zero interest rates and their extraordinary performance, uh, they became $5 billion funds. I mean, I woke up one day and saw people who I knew, when I was young, who managed $10.50, and next thing you know, they $5 billion. So one, it's not a natural transition because it's a different there's more people, there's different processes. It's hard. The second thing is timing is everything. The one thing we know about investing is it's never going to go in a linear fashion. Hopefully, it's always moving up and to the right, but it's going to flow. And that's okay. Because if you're in it and you're consistent, you'll ride out the storm and you'll do fine. So the big funds who consistently had 10 or 5 or 15 billion dollars, okay, they hit the swoon. It's
Yeah.
okay. And they just come back because everyone's marking to market. But if you raised your $5 billion fund in 2019 on top of your last fund, which is 2.5 billion, and that's the fund that got hit because of market conditions, that's not good.
Yeah.
And so that's exactly what happened. And that has caused real consternation amongst the investment community, the pension funds and the like, to say, until I see that capital come back to me, until I see that you are good stewards of that significant capital raise that you made, I'm going to be cautious. At the very least, I'm not going to give you as much, and that is the reason why the small cap market has been more reluctant to get rid of their troubling assets because they don't want to mark down their portfolio in the face of fundraising.
You mentioned mark to market there, Mark. That's been an issue too, with a lack of activity going on in the marketplace. People were reluctant to sell for the real value of those companies because they didn't want to take the hit in their markup. Is that starting to ease now?
It, it it's showing signs.
Yeah.
So we call that capitulation. And so I think where some of the capitulation has come is, okay, I know I bought it for 18 times. Maybe I could sell it for 14 times. And when I look at the fact that I've grown the business, my cash on cash return, my MOIC, which is the money
Mm-hmm.
I get on my investment, is okay.
Yeah.
But there are instances where it's not.
And tell me about Solomon Partners today. I know you did something different. That is, you sold the majority stake of the business to a French bank, was it?
10 years ago, and coincident with when you mentioned I took over as CEO, we were going through our transition. Peter was the founding partner. Peter was, as we refer to it, our benevolent dictator, and it was a great firm and very
Mm-hmm.
bespoke, but very focused and always small. He never wanted to grow. And as you know, Jim, from your background, one of the leading investment banks in the retail space, continued to
Sure.
be. But the time was that transition was necessary. I met an interesting group in France that he actually had known through historical relationships. And the stars aligned. These guys, which are together with their holding company, their parent company, the second largest financial institution in France, they were looking for strategic advisory capability in the US. They were smart enough to know that if you bought an investment bank as a foreign entity, I think the success rate was zero. And so they said, let's partner. And what they loved
Mm-hmm.
about what we had is, one, the selling shareholder wasn't the future.
Mm-hmm.
And I like to say at that time, the younger partners had a shared vision, which, hey, let's grow this firm. Maybe it's a bit
Yes.
brash, but let's take this show on the road and see what we can build. From at the time was one of the oldest, if not the oldest, living independent boutique.
Mm-hmm.
Predate Mobilis and Evercore and Centerview, all these guys. So the transaction sort of matched up well, where it was a partnership, and everything was
Mm-hmm.
designed to drive growth. And it was great. I mean, they're wonderful partners, and we really run an independent business. The capital that they gave us to buy their 51% was largely for Peter to realize on the value he created through all these years and to continue to
Yeah.
participate.
Hmm.
And the idea was to grow. So we were 35 bankers net, let's say, when we started this exercise back in 2016. We currently sit somewhere at 220.
Wow, that is a
Well,
lot of growth.
that's a lot of growth,
Hmm.
not without its ups and downs. A lot of learnings go into these things. Uh, uh, 13 industries that we focus on. Our largest platform is probably at this point healthcare, second to FIG, distribution. Retail continues to be a very important part of our business, but you know, a more modest percentage of the business.
Yes. Hmm.
And we're probably at the third inning, second inning of growth relative to when you look at our competitors at Moelis. We have 225. Moelis is 1,000, and Evercore's got 2,000, and you go on and on. So it's a pretty exciting opportunity.
Tell me about how you've expanded your geographic footprint.
Geographically focused.
Hmm.
Our focus is on people. We have a great firm. We have a great reputation. I think we're known for being deep industry experts, great bankers, and honest people who you trust. Uh, at the end of the day, though, it's our bankers who drive value, who drive the business. They're great, individually great. So, frankly, my attitude is people say, well, geographic, industries. Yeah, sure, there are nice places to be. There are great industries to be in, but I'll take a great banker who sells Scotch tape over someone, doing software, if they fit our, as we say, our three pillars of success. So we really go where the bankers are. Right now, biggest footprint is in New York. Second would be in Chicago. We have a fairly active office in Tampa, of all places, again, going to where the number one team focused on distribution companies happens to exist,
Hmm.
who are superstars. And so we have a lovely Tampa office. You wouldn't believe how difficult the Tampa market is. It's really they hear about Palm Beach and West Palm, Tampa.
The bankers that you tend to bring into your company, are they coming from bulge bracket firms?
It is a mixture. So we have a fair number of bulge bracket people, Goldman and Morgan Stanley and the like. We've got a lot of folks from the we refer to as the elite boutique. So Moelis and Evercore and others. And then from the regionals, and the regionals would be Houlihan, Blair, Baird. The distribution team was Baird. So it's a smattering of folks. I think the wind is a bit at our back in terms of our ability to attract new talent, because a lot of these firms have really gotten a bit crowded,
Mm.
and are moving more up market because they have to in order to drive growth. And we're one of the few opportunities where you can walk into a real partnership, you have room to breathe, you have white space to do your business, you have an incredible wealth creation opportunity with our growing our business and creating equity value. And
At Harry and David, we work with our hands as well as our hearts, so you can enjoy sharing it as much as we enjoy making it. And that's what life's really all about, sharing with those we're closest to, no matter how far we are apart. Harry and David, share more. In working as you have all these years around all these different businesses, there's always the one that got away. The deal you thought you would do, and then you decided you wouldn't do, and then you didn't do, and then you say, why didn't I do that? Which one was that for you?
that's funny. I was talking about the other day. Uh, my old friend John Idle, John, who is probably one of the top operators in the apparel retail industry, among others, but he's good. He's really good. And so we sold his company way back when. I sold his company way back when. It was out of bankruptcy, interesting enough. One of the few circumstances where he came in and created equity value in bankruptcy. So we distributed. I mean, it was 100 cents on the dollar to the creditors, and equity got value. And then he immediately went and joined Silas Chow and Lawrence Silas Chow and Lawrence Stroll when they started and bought Michael Kors. They had been an enormous success in Tommy Hilfiger.
Sure.
So we remained friends and talked and did business. And he came to see me one day, sent his car for me, brought me up to his office. Beautiful. He's with the guys, and he said, "Look, we're looking to raise $60 million. We'd like you to raise that money." And he said it would be like at I don't remember the number, $100 million valuation. And I said, "What are you kidding?" Well, long and the short, it was $8 billion valuation. It was an opportunity missed, and I think the lesson learned there is, yes, values are important, and buying things at what you think is quote unquote fair value is extraordinarily important. But when you have extraordinary entrepreneurs and extraordinary operators, you got to see a little bit past it.
And then on the other side of that coin, when you're gathered having a glass of wine at the end of the evening, when you put on a beautiful event in Miami, adjacent to Art Basel, and you have all these wonderful family businesses and middle market businesses gathered, and they ask you, tell us one or two that you're most proud of, that you maybe it wasn't the easiest, but you're really proud of, and really sets the brand level for what Solomon Partners is.
Well, again, I think about the ones that I'm associated with, having the most
Sure.
knowledge, and oh, by the way, this great event where you were a keynote speaker and added incredible value to all those great companies around, hearing.
Some wonderful people gathered there. I've made some friends that night that I think will endure for a long time. Some really good and interesting people. A lot of people doing a lot of good work that I've met.
Yeah, I love that, and part of our practice, which I love, is that we've always had a big family owner practice, and it is in fact the one that brings the most joy to a great success. In any event, I remember way back when. I remember Zales, the jewelry store, and they were having a hard time. It was a long story, 8 CEOs in 10 years, and all the things you don't do in running a retail business. They had hired a competitor to help them think through how they get out of this. And the competitor, as I was told the story, sat down with the then chairman and said to the chairman, bankruptcy is a very advantageous way of resetting retailers, because you can close stores, you can do this, and emerge, unfettered. The chairman then proceeded to tell the 2 bankers, "You do realize I'm the largest equity owner." So that was the end of those bankers, and they brought us in. And while we have great restructuring capabilities, our attitude is, how do we create value for shareholders? That's what Peter started this firm on. That's what our focus is, no matter what. Yes, at the end of the day, sometimes it doesn't work out, but you could never be a hammer looking for a nail. You can't just say, this is what I do, and therefore that's what I'm going to suggest. You have to have the holistic perspective of how you create value using all the tools available to you, including your restructuring group, including your capital raising group, including your M&A group, and including your industry knowledge. But we came in and said, geez, this is not very complicated, because you have a competitor down the block and they're killing it. Why don't you just look in their window and see what they're doing and just do it? And so we said, you know what? There's another alternative. We came up with a very unique structure for raising capital. Brought in a private equity group who's very knowledgeable in retail. At that time, interestingly enough, it was Stefan Kaluzny, who at the time was still at Golden Gate. And it was right before
That's
he
right.
made his move to go independent
With
uh,
Sycamore.
at Sycamore. And it was one of Stefan's great successes. And they went about slowly but surely in fixing the company. The stock was down at $2. It ended up selling for $21, $22.
You mentioned Kidder Peabody, and of course, I think of what connections I have. And as I mentioned to you when we were last together, when I had my first flower shop on First Avenue between 62nd and 63rd Street in Manhattan, one of my first important customers was a fellow by the name of Marty Siegel, but more importantly, his really nice wife, whose name was Jane Day. So your connection to an infamous guy at Kidder Peabody is we're linked on the back end of that as their florist. And not to be outdone by your connection to Zales, when we first acquired the number 1-800-Flowers, the first promotion we did was with Zales. And I was just telling the story here at 1-800-Flowers last week. The promotion was they came to us and said, how do you help us to close a sale? What's your situation? We have men come in for Christmas, and they'll come in as early as early November, but they won't make a final decision until we get too close to Christmas, and it's hectic and it's crazy, and we're just looking to lengthen the sale process, shorten the sale process, lengthen the sale window. And the thing we all came up with was, if you were to buy today, sir, we will give you a beautiful poinsettia plant that you can send anywhere in the country to anyone you want. And that gave them a close mechanism. And it was hugely successful. And we were in the office every day and because of the new technology at the time, Mark, they would fax us these orders every night on this curly paper, and we'd be trying to lay them out, and it was a huge success for them, and it was a huge success for us. But so that's our connection to Zales. Who's next?
That's a good story.
You wrote a piece that I saw, I think it was in Forbes in July, about the changing world of activism. What mean you?
What mean you? So,
activists normally they come into your stock, they maybe lever their position, maybe they work with a few other people who are shareholders, and they yell and scream and tell you to make changes so that the stock goes up and they can get the hell out.
So that was historical activism, and it was either characterized by tough guys back in the day, like the Green Mailers, and well, maybe only you and I know that.
Steinberg.
Steinberg, right? Exactly. Icon to some degree, but
Yes.
guys who aren't necessarily all that focused on operations of businesses, but they were focused on vulnerabilities, and so that was the first phase. The second phase came in a little bit of knowledge that you have undervalued assets. If you pushed, hoopla, if you created PR around a situation, you could get uplift, and then yes, boards would acquiesce and do buybacks and do this and do other things that were financially advantageous to stock prices, not necessarily improving businesses, and they'd sell out and make money.
So how has it changed?
So now, and by the way, and then you had a group of people who had no idea of the companies they were involved in. I had a situation where is in a retailer, I won't mention the name, and he became an activist. I spoke to him, and he said, "Here's what things I'm going to do." I said, "You don't know what you're talking about. You have no idea." He's out of business, by the way. So how's it
Not
changed now?
surprising.
Yeah, not surprising. How's it changed now? Now you have people, and it's a little bit of a check and balance, who really do know how to fix things, who really do know operating, who really care about the long-term success of the business and aren't simply focused on short-term profits. And what they're doing is keeping boards and management teams honest. And that's not a bad check and balance. And they're not flamethrowers. They're not looking to a short-term gain. They're looking to do the right thing. And these are people of note. Uh, take Nelson Peltz. I mean, you can't criticize Nelson's ability to run a company and his knowledge of businesses and his success in taking a disparate number of different operations and making them better. I have a friend, and one of my closest friends is Jim Matiratunda from Barrington Capital. And I know Jim for 40 years, and I know his soul, and all he cares about is doing well by shareholders. All he cares about is waste. He cares about better operations. Is he always right? Of course not. But his intentions the right intentions? Absolutely. And it's funny. He goes on a lot of boards, and now he's at the point where he could point to independent board members that had nothing to do with him. They're just other members of the board who would say he's a great guy. So I think you see a little bit of that. Nothing's perfect.
Yep.
But the knee-jerk reaction shouldn't be, how do we defend ourselves? The first reaction should be a bit of introspection. What are we doing? I mean, what are they telling us? Now, not always the case. Sometimes it's, there's some bad guys. Sometimes they're ill-informed. Sometimes they're looking for short-term activity, which is not appropriate given the circumstances, and you have to weigh that. But it is of a different ilk.
Make birthdays even happier with buttercream frosted cookies, dreamy cakes, and more. Wishes come true, one bite at a time, with tasty surprises from Cheryl's Cookies. So there's a group of emerged activists who are thoughtful, have real skill sets, and are looking to do the right thing for all of the shareholders.
Again, it's not always the case. It's been around for a bit, but the one thing you see sometimes is boards get nervous because they think it's a referendum on them. It's not.
Sure. Mm-hmm.
It's not. I am the first person to say I don't have all the answers. I welcome people coming to me and telling me here's a better way. It's good for me.
Sure.
So you put ego to the side and you say what's best. And maybe your conclusion it's not best, and that's fine.
The number of companies that trade in the public markets has halved in the last couple of decades. What do you think happens going forward? There's some big rumored IPOs in the pipeline for 2026. That'll be interesting to see if they come and how that goes. But in general, has the world changed so that it seems to me it's a lot less attractive to be a public company from a regulatory point of view? And the rise of all these private capital that you've talked about, both in the form of debt and in equity, has risen so much about the bloat that you spoke about in the private equity community that you don't have to go public for capital purposes, maybe as much as you did a decade or two ago. So what are your thoughts about the public marketplace and the two aspects of the private marketplace, private equity and private debt?
Well, we have one of the greatest financial markets in the world, and all these new capabilities and products are great ways to both grow one's business and also to monetize stakes in the business, which are all reasonable things to do. I don't think the public markets are going away. Do I think they will be not as active as they once were because of the additional capital that's gone into the private market? Sure. There's no doubt. I think...
Where is the pendulum now? Is it swung out? Is it out as far as it'll go?
It's probably swung away from the public markets, given sort of the difficulties in the general capital markets, interest rates and so forth. Yes. So it probably has swung more towards to the negative, and I think it will swing back. I think the public markets are probably better for the large cap businesses who
we have rumored OpenAI. We have SpaceX rumored to be coming. These will be huge companies.
And Medtronics and other, because again, those are difficult in the private markets, because part of the private markets, one of the questions a private equity investor has to ask, because this is their profile, they don't buy it in perpetuity, they have a window, and so the question they have to ask themselves is, what's my exit? So all of a sudden, if you're building a business, that you buy a business that's worth 5 billion, 10 billion, and you want to double it, you want to, grow by 50%, right? Who's buying a $20 billion business? It's just a more limited universe. Here is where the public markets can come into play as being a possible source of exit, and it has been in the past. Here's also where they come into play to be acquirers of other companies within their industry that give more exit potential into the marketplace. So I think it's a holistic system that works. And it doesn't mean that small cap companies won't be active. They will. They'll have their moments. SPACs will come back, and they have. And you've seen them.
Have they yet?
They come back, yeah.
Mm-hmm.
I don't think they're going to come back with the ferocity they did way back when, and they shouldn't.
That was once in a moment.
It was once in a moment. And, my view is SPACs are largely a mid-market instrument. They shouldn't necessarily be a large cap instrument. It's very hard. But put that aside. Private credit markets are a great thing. And I wrote an article about that as well, when some people were maligning the opacity of the market, and I'm not sure what opacity means. It means that private equity or private capital is raised from institutions and run by very, very smart individuals who are underwriting risk.
Mm-hmm.
They get it right, they get it wrong, and they drive a return. And it is a direct competitor and supporter of the public markets, and the public markets make sense too for debt. But interestingly about the public markets, and over the past bunch of years, particularly post 2021 boom, the LBO market would have been out of business if we didn't have a private credit market. Because keep in mind how the LBO market, public market, works. It doesn't underwrite risk. Banks don't buy debt and hold it. They originate to distribute. So, yes.
So they don't want it on their balance sheet. They want the fees. They want to syndicate. They want to move it along.
So what they underwrite to is the sale. So what they say is, who's going to buy it? Not necessarily is it a good credit. Now, of course, they say it's a good credit, and of course they believe in the asset, but they underwrite to who's going to buy it. And whereas a private credit investor who takes a bit of higher return because they have lack of liquidity, that's appropriate, they underwrite to own. And so that market never ends if they believe in the company and believe in the economy. So, everyone's going to have their faux pas. I was involved in Saks, and a year ago, Jefferies raised, $2 billion. The bonds are trading at 7 cents.
But as you watch the rest of the world, it's a little bit different landscape, and it'll be interesting seeing how it plays out. I'm glad you think business looks good for next year, because that sort of drives a lot of other things, especially the narrowing the gap between the haves and the have-nots. So I hope your forecast is spot on, because a good economy helps a lot of ships rise. Marc, thanks for being with us today. Thanks for sharing your experiences, your knowledge, your insights.
Again, Jim, great to see you, and thank you for having me. And hopefully we'll enjoy more good times together.